everyone. This is Maheen, and welcome to the CanadianSME Small Business Podcast. Today, we are exploring the highest stakes milestone in the life of an entrepreneur, which is the business exit. Because in 2026, successfully navigating a mid-market merger or acquisition requires far more than just a healthy balance sheet. It demands strict preparation, objective valuation, and a deep understanding of institutional deal execution. Joining us is Andrew Kemper, a partner at Capital West Partners, one of Canada's premier independent M&A advisory firms, a chartered professional accountant and chartered business valuator. Andrew brings over 20 years of corporate finance experience to the mic. He has guided Western Canadian founders through more than 40 complex transactions with a combined deal value exceeding $4 billion. He's also the conference chair for the Business Transitions Forum and a passionate mentor in the Vancouver community. So without further ado, let's dive in and welcome Andrew. Andrew, it's a pleasure having you on the show today. Welcome to the podcast. How are you?
Good, thank you. Thank you for having me, Maheen.
Very pleased to have you with us this afternoon. Now, Andrew, let's open a discussion by understanding the mid-market M&A trends and valuations, because the mid-market M&A landscape has shifted significantly over the past couple of years, really forcing business owners to look closely at how valuations are actually calculated. Please tell us what M&A trends and valuation changes should Canadian business owners understand today?
Sure. Yeah, what we've been seeing, especially like in the back half of 2025 and the first half of 2026 here, we've seen a big increase in transaction volumes. There was a slowdown in early 2025, a lot of it with relation to geopolitical uncertainty and the tariff regime in the US that came into Canada, caused uncertainty for business owners and buyers alike. And so there was a slowdown in the first half of last year, but it picked up a lot in the back half of last year, and has continued, in this the start of 2026. We've seen transaction volumes have been reported for Q1 was up 10% compared to Q1 for 2025. So there's lots of healthy activity in the M&A space. When we look at businesses, between 10 and 500 million, which is what we think of as mid-market, the valuations are still healthy and really good for good quality businesses. In Q1 alone, the average multiple paid for those businesses in mid-market was about 8 times. And that is a bit higher than last year. Last year was about 7.4 times average for the whole year. So things are healthy. I think it's sector specific. There's some sectors that are performing better than others. And that's really, a lot of that is related to tariff-based issues and concerns. So, auto industry in Ontario probably is having a tough time, but things like industrial services, business services, financials, tech, they all seem to be doing reasonably well. There's good demand for businesses. You've got public companies that have healthy balance sheets and are sitting with pretty robust valuations. And then the biggest thing is you have a private equity world where they've got, in North America, I think the most recent stat was they have something like 2 trillion of dry powder. So committed funds that they need to spend over their fund's lifetime. So the buyers are definitely there. There's a big demand for mid-market businesses across Canada.
Mm-hmm. Well, that's an important lens for today's market, Andrew, because it helps us understand how valuations are shifting, and it helps founders take more of a grounded approach to position their business and really avoid relying on outdated assumptions when planning an exit. Next up, let's explore what goes into preparing a business for a successful transaction process. Andrew, what should founders prepare before taking their business to market?
So, I always like to think of it as good quality businesses are built to be sold at some point. So it is that it's a constant evolution of building that business so that it's ready to be sold. And I don't know if there's anything like specific about preparing that you need to do other than you need to have a well-run business that is ready to sell. And there's lots of things you can do to do that. I'd say one of the biggest things is building a team. And that's building not only the internal team, but an external team. So it's who are your key people? You need to think about, do you have a good finance person? Do you have a good ops person? You as the owner can't be so important to the business that you need to do everything, because if you do, your business really isn't saleable, because personal goodwill can't sell, right? Buyers want to buy well-run companies that have great management teams. And then obviously building also external advisors. So you need an M&A advisor. You need a good M&A lawyer, someone that actually specializes in M&A, not just a kind of general legal person, and obviously a tax accountant. So build a good team is a big thing. I think the next one is to prepare for the rigors of due diligence. This isn't an easy process. It's a pretty rigorous due diligence process when you sell a business. So, get your house in order. Make sure you have good, clean financials. Know all your contracts really well. Have them all in one place. Have them signed. We'll often see businesses that have all their contracts, but some of them aren't signed. So then they have to go chase signatures as part of the diligence process. And I think it's also knowing your data. So how do you track your business? How do you know that your business is a well-run business? Do you have monthly KPIs that you monitor to know that you're running a good business? And be able to provide that information on a really timely basis to buyers is very important. And I think the last piece that really kind of sets businesses apart, and I think has the biggest impact on creating good deal tension and maximizing value, is having a growth plan. Really knowing how you can grow the business, because that's what buyers want to see. They don't want to just say, buy the business and keep it the way it is. They want to be able to see something where they can grow on it and then really build a growth plan on it. So having a good, credible growth plan and being able to present that, I think, is a huge factor in making sure you maximize value.
Mhm. This is a great starting point, Andrew, and it helps us, understand better that preparation is often what determines how smoothly a process really unfolds. And a well-structured approach, it helps maintain business stability while also creating a more competitive and controlled sale environment. Next up, let's look at the key factors that actually drive value in Canadian businesses from a buyer's perspective. Andrew, what operational strengths increase a company's value to buyers?
Yeah, there's a bunch of factors that are value drivers for Canadian mid-market businesses. We always like to think of these as, what is a buyer looking for in a high quality business? So we talked about it before, but that high quality management team, making sure you have a really good management team. Again, you can't sell personal goodwill. So the owner being the primary person in the business, a buyer will see a massive risk around that, because they're going to buy the business and then wonder, okay, are you sticking around? Are you going to continue to run it? So they want to see a well-rounded management team with multiple people running the business, so that if the business owner does step away after the sale, the business continues to run well.
Mhm.
Quality of revenue sources is huge, and diversification. So do you have diversified revenue, whether that's across geographies, customers? You can sell businesses that have customer concentration, so a lot of revenue with one customer, but it's a lot easier if you have a nice well-diversified revenue source from numerous customers. You want to eliminate the customer dependence as much as possible. Recurring revenue obviously is more valuable than a one-time project-based revenue. And you want your revenue to be sticky. You want to be able to show that your business has been run for a long time. You have a lot of repeat, high quality customers. Those blue chip customers are part of your customer makeup. And obviously margins that stand up to the test of time and stresses of economic environment and things and changes, inflation, those kinds of things. If you have revenue and margins that stand up to that, those fluctuations in the economic environment, that's a really high quality business that people are getting excited about. I think the last piece again is the growth opportunities. If you have historical growth, that's evidence that you've been able to do it in the past, and buyers obviously really like that. And then obviously being able to show us future potential and a well-developed plan to maintain that growth and continue, whether that's inorganic, where you actually have some targets that you would go buy businesses and build onto the business you already have as an add-on, or just organic growth where you're expanding into the existing customer base you have, but adding customers, adding market share. Those are huge in terms of determining value. So those are things that you can do, obviously, to increase the value of your business.
That's crucial insight, Andrew. I mean, businesses, they can reduce owner dependency and really demonstrate predictable, diversified performance, tend to stand out more strongly in competitive deal environments. Now let's take a step back and look at what decades of real world deal experience reveal about successful transactions. Um, What separates a successful business sale from a failed deal?
Yeah, and I think it's funny because when we look at this, and we think about failed deals. We haven't had a lot of failed deals at Capital West, and I think that's because of how we approach deals. I think if we were to just take on every deal and every company and just run a process, we might be shooting in the dark a little bit and have more failed deals than we've had. Because I think a lot of what we do in the 20 years I've been at Capital West is we do a lot of upfront work to make sure the company's ready for a sales process and then it's going to be attractive to the market. And when I talk about that, I think it's like we do our own due diligence on the business as if we are a buyer. What would we look at if we were a buyer, and making sure that we're reviewing that and assess the business from the lens of the buyer. And then a key thing we also do is detailed research on potential buyers to know who the most strategic buyers are that would really take an interest in a business before we even think about approaching them. So deals probably fail because of lack of preparation and lack of insight into actually assessing the business before you go to market. So that's kind of where things kind of can go wrong, I think. In terms of the successful sale and what makes a successful sale, obviously the quality of the business is key. So looking for a well-run business that is built to be sold, optimized, running efficiently, has good reporting, good data available. The team is a high quality business. That obviously helps. Planning, making sure the business and the management team are ready for the process. So having lots of discussions about, okay, what is the objective of the owner, and making sure we can actually reach that objective, and making sure that they and the management team understand what is kind of required as part of the process and the different steps to get to the closing, before they just jump in kind of randomly. Proper positioning. So, obviously highlighting the key aspects of the business is super important. We know that if you just put a whole bunch of data about a business onto a page, the buyers will get lost in that. You really need to be able to position the business properly and highlight the key investment highlights that a business that a buyer can get excited about, instead of just giving them a bunch of information. So it's all about the package you put together and how you position it, and then obviously approaching the right buyers and creating a competitive deal tension is massively important. So like a couple of recent deals that were successes here, and kind of it has all of those things encapsulated into it and running a good process. We sold an insurance brokerage business, as an example, about a year ago. We had 15 initial offers from groups, and the valuations were like 30% above kind of what the expected market value was. And it was because the business was really well run, we positioned it properly, and we approached the right buyers in the sales process to be able to create that competitive deal tension.
Mhm. That is a good overview, and thank you so much for sharing that experience, because it really highlights how important preparation and steady guidance are. And even strong businesses, they can face challenges late in the process without the right structure and support in place. Finally, Andrew, let's talk about why early planning is so important when thinking about a future business transition. Tell us, why is early transition planning important for business owners?
I think the biggest thing is people don't know what they're getting into sometimes, right? They don't understand how the process works. They don't do this every day. They run their business, and they run great businesses. There are a ton of great business owners in all across Canada in this mid market that are very sophisticated in what they do, but they don't do this every day. This is a once in a lifetime, usually once in a lifetime, once in a couple, maybe a couple times in a lifetime transaction for people. So if they haven't gone through it before, they don't understand the demands. So I think the planning process, one of the keys is it's not an easy process, so they need to understand and ensure they are ready for the process before they get into it. Knowledge of how the process works can make a big difference in the eventual outcome. And the big piece, I think, is also the early planning, is because this work takes time. It's not something that just happens overnight. So in order to make meaningful changes to the business, you have to have, the more lead time you have, the better. So take your time, make sure you're ready before you go into a marketed process. If you can know the valuation drivers that we talked about, we know those up front, and can build that into your strategic operating plan and make some changes over the next 1 to 2 years before you go to market, that can have a huge impact on the business. And I think the last piece is obviously the sticker price on the business is great, but at the end of the day, tax planning is huge. The amount that the owner actually puts into their pocket at the end of the day after paying taxes, if they can do some tax planning around that, is very beneficial. And again, that is something that takes a tremendous amount of lead time to put things in place to make sure that you have that tax planning. So that's an important thing to make sure you give yourself some time. So a lot of times, it may take a year to two, maybe 3 years even, from the first time we talk to a client to the time when they actually run a sales process. And we can help them with all this planning to get ready for the point where they actually go to market.
Right. That's a key takeaway, really. I mean, early planning, it gives owners more control over timing, structure, and outcomes, helping ensure a smoother transition and a stronger long-term legacy. Thank you so much for such a meaningful conversation, Andrew, where you really demystified the corporate finance process. Um, if early, it ensures that Canadian entrepreneurs can successfully transition their wealth and really protect their company's legacy. So thank you for highlighting how to be really prepared the next generation for transitions. As we wrap up, what advice would you give owners that are preparing for a business exit in the next few years?
Probably being kind of a bit repetitive of what we've talked about, but really at the end of the day, there's probably three key pieces of advice I can give owners is, the first one is obviously make yourself redundant, build a great management team around you. You can't sell personal goodwill. So if you can take a month of vacation and your business still runs properly and runs efficiently, you probably got a great business as an owner. The second piece is prepare and plan early. It's a rigorous process for the business, but also emotionally for the owner. So you need to prepare and get yourself ready for the process before you jump into it. And then I think the third piece would be obviously to utilize a great team of external advisors. And that, obviously includes M&A lawyers, M&A advisors. They help you prepare for the process. They do the heavy lifting during the process, whether that's marketing or due diligence and managing that process, and then the negotiation of the agreements. So you can focus on the day-to-day operations and make sure your business runs smoothly throughout the process. Because the greatest thing you can do to make a good sales process is making sure the business continues to operate really well. Most importantly, they're experts at positioning the business. They ensure your business gets to all the right buyers and the most highly strategic buyers, and they create deal tension to ensure you maximize value and receive a premium offer for your business in the long term.
That is an excellent reminder that a premium exit isn't an overnight event. It's quite a multi-year discipline of intentional preparation. Thank you
Absolutely.
so much, Andrew, and thank you for sharing such great expertise and your insights with us. Thank you for your time.
Thank you for having me today, Maheen. Very nice to have the conversation.
And listeners, that was Andrew Kemper from Capital West Partners, a masterclass in mid-market M&A architecture, mechanics of business valuations, and how Canadian founders can successfully protect their life work during a corporate sale. Thank you for tuning into the podcast. Please be sure to subscribe and visit CanadianSME.ca for more resources. And to learn more about how we're supporting the ecosystem, please visit Canadian SME Small Business Foundation at smebfoundation.ca. And before we leave, a special shout out to UPS and ADP for their ongoing commitment to empowering small businesses across Canada. Please keep thriving, and we'll see you in the next one.